SCHD, one of the most popular dividend ETFs, recently announced that it'll be splitting its stock. Sounds like a lifetime opportunity for many investors. Well, as whispers of the split circulate among investors, in this video, we'll discuss the burning question on everyone's mind. Number 1, what does this mean for SCHD? And number 2, is this the golden opportunity investors have been waiting for to buy SCHD? Before we dive in, show your appreciation by clicking the like button below, subscribe to the channel, and turn on notifications for more valuable content. Now, let's jump into it. SCHD has been a favorite ETF for income-focused investors, offering an irresistible blend of steady dividend growth and capital appreciation. Since its inception in 2011, this exchange-traded fund has carved out a reputation for delivering consistent returns and a growing stream of income. Tracking the Dow Jones US Dividend 100 Index, SCHD provides exposure to 100 high-quality dividend-paying US stocks. Its methodology focuses on companies with a track record of consistently paying dividends, strong fundamentals, and relatively high dividend yields. Now, here's what sets SCHD apart in the crowded field of dividend ETFs. Its emphasis on quality. The fund doesn't just chase the highest yields. Instead, it seeks out companies with strong financial health, sustainable payout ratios, and the potential for long-term dividend growth. This approach has resonated with investors looking for a balance between current income and future growth potential. With a low expense ratio of just 0.06%, SCHD has become a core holding for many portfolios, offering cost-effective access to a diversified basket of dividend aristocrats and contenders. Now, let's turn our attention to the main focus here, which is the stock split. A stock split is a corporate or administrative action in which a company increases the number of its outstanding shares while proportionately decreasing the price of each share. For example, in a 2-for-1 split, an investor who held one share priced at $100 would suddenly own 2 shares, each priced at $50. Here's an important factor to note. While the number of shares changes, the total value of the investment remains the same even after the split. But why would a company, or in this case an ETF, consider a stock split? The reality is that the reasons can vary, but they often boil down to psychology and accessibility. As share prices climb higher, they can become intimidating to smaller investors. But a split can make shares appear more affordable, potentially broadening the investor base and encouraging more people to invest. In the case of SCHD, a stock split could be seen as a strategic move to maintain its appeal to a wide range of investors. As the fund's net asset value has grown as much as $60 billion over the years, with shares skyrocketing by approximately 22% in the last year, the split is probably in place to reset the share price to a level that feels more approachable to newer or smaller investors. This could potentially increase demand for the ETF, leading to greater inflows and liquidity. Now, here's the best part. The SCHD ETF stock split scheduled to commence on October 10 comes with outstanding offers. With a wide range of diversified portfolios with a 3-to-1 investment ratio, investors stand to get 3.4% dividend yield and even a 5-year dividend growth of 12%. However, it's crucial to understand that a stock split doesn't change the fundamental value of an investment. Let's just say it can be likened to cutting a pizza into more slices. You still have the same amount of pizza, just divided differently. The intrinsic value of SCHD would remain unchanged immediately following a split. What could change, though, is market perception and investor behavior in response to the split. So with all this in mind, is a potential SCHD stock split a buy signal or not? Let's break down the pros and cons. On the buy side of the equation, there are several compelling arguments. First, the increased accessibility could lead to a surge in demand for SCHD shares. If more investors can afford to buy lots of shares or feel psychologically more comfortable with a lower share price, it could drive up overall interest in the ETF. This increased demand could potentially lead to price appreciation in the short to medium term. Moreover, the added liquidity that often comes with the stock split can be beneficial for all investors. Tighter spreads means lower transaction costs, and easier trading can make the ETF more attractive to a broader range of market participants, including institutional investors who may have liquidity requirements for their holdings. Furthermore, SCHD's underlying strategy and holdings won't change due to a split. Investors would still be getting exposure to the same high-quality dividend-paying companies that have made SCHD a popular choice. The fund's track record of dividend growth and total return performance would remain intact, split or no split. Lastly, for long-term investors focused on dividend growth, a split could present an opportunity to acquire more shares at a psychologically lower price point. This could be particularly appealing for those practicing dollar-cost averaging or dividend reinvestment, as they could potentially accumulate more shares over time. However, the not buy argument also carries weight and deserves careful consideration. First and foremost, as mentioned earlier, a stock split doesn't fundamentally change the value of an investment. Buying solely based on the announcement of a split without considering the underlying fundamentals and valuation could be a misguided strategy. It's always wise to base investment decisions on concrete information and the thorough analysis rather than market gossip. It's also worth noting that the initial excitement surrounding the split can sometimes lead to a short-term price bump that may not be sustainable. If investors pile in based on the split news alone, there's a risk of the price becoming inflated beyond what's justified by the fund's fundamentals. This could potentially lead to disappointment or losses for those buying at elevated levels. At this point, let's take a look at the value propositions of some of the top 10 SCHD stocks involved in the split by considering their price-to-earnings ratio or forward PE value within a year and its estimated 5 years value according to stock analysts. So here's the thing. PE ratio helps determine if a stock is overvalued, undervalued or fairly valued, and this helps you to know whether or not to buy. The first on the list is Home Depot with a 1-year PE value of 25.29 times compared to its 5 years PE value of 22.7 times. This stock is overvalued. The second one is Verizon with a 1-year PE value of 9.52 times compared to its 5-year value of 9.9 times. This stock is fairly valued. Next is Pfizer, which has a PE value of 10.11 times and 5 years PE value of 13.9 times, making it undervalued. There's also the Lockheed Martin stock, and this has a 1-year PE value of 20.43 times with a 5 years PE value of 16.6 times, making it overvalued. Next is Cisco stock with a 1-year PE value of 14.76 times and a 5-year PE value of 14.7 times, making it fairly valued. Another stock on the list is that of Chevron, and this is 1-year PE value of 13.37 times compared to its 13.3 times 5 years PE value. This means that it is undervalued. Next is Texas Instruments stock with a 1-year PE value of 32.15 times compared to its 5-year PE value of 23.8 times. This one is overvalued. Next is the BlackRock stock, which has a 1-year PE value of 20.08 times compared to its 5 years PE value of 21 times, making it an undervalued stock. The Amgen stock is overvalued with a 1-year PE of 15.10 times compared to its 5 years PE value of 14.7 times. And 10th on the list is the Bristol Myers Squibb stock, which has a 1-year PE value of 7.15 times compared to its 5 years PE value of 9.1, making it an undervalued stock. From all of these, it's very clear that only 4 of the top 10 stocks that make up 41% of the SCHD's total fund are undervalued and have potentials of experiencing price appreciation over time, while the others are either overvalued or just fairly valued. Ultimately, whether SCHD is a buy with or without a split comes down to individual investors' circumstances, risk tolerance, and investment objectives. As with any investment decision, thorough research, careful consideration of personal financial goals, and possibly consultation with a financial advisor are recommended before making any moves. While a potential stock split for SCHD is an interesting development to watch, it shouldn't be the sole factor in making a buy decision. However, investors should approach the situation with a clear head, focusing on SCHD's fundamentals, its fit within their overall investment strategy, and their long-term financial goals. Thanks for watching this video to the end. Let us know your thoughts in the comments section. And don't forget to like and subscribe for more valuable content.